How I turned $500 into $5,000 in 6 months. You're looking at a $500 trading account. Now look again. This is that same account, just 6 months later, sitting at over $5,000. So how did I do it? Over the next few minutes, I'm going to give you the transparent, unfiltered story of a high-stakes challenge I set for myself. This isn't a get-rich-quick scheme. It's a documented experiment into what it takes to 10x a small account. I'm going to show you the small-cap stocks I traded, my exact research playbook, the moments I almost blew it, and every lesson learned along the way. Now, this wasn't about day trading dozens of stocks or using some complex algorithm. It was a very specific, high-conviction strategy focused on a tiny number of small-cap stocks I believed were coiled for explosive growth. But let's be crystal clear from the jump. This approach is extremely high risk. It's not for everyone. The volatility with these kinds of stocks is intense, and while the wins can be life-changing, you can lose your shirt just as fast. This is not financial advice. It's a case study of my personal journey to show you what's possible when you take on calculated, asymmetric risks. So stick around, because I'm not just showing you the highlight reel. I'm showing you the losses, the psychology, and the hard-won lessons that were honestly more valuable than the money itself. The setup. Why start with $500? So, the big question. Why this challenge? I've been investing for years, and most of my money is in boring, long-term stuff. But I kept hearing from people who felt stuck, like they could never get ahead starting with just a little bit of money. They're told the traditional advice of aiming for slow, steady annual growth means it'll take them decades to build real wealth. And honestly, they're not wrong. With a small account, the old-school methods are a painfully slow grind. The problem is, that classic advice to only risk 1–2% of your account on a trade just doesn't move the needle when you're starting small and aiming for big growth. Risking $10 on a $500 account to make a 20% profit nets you a whopping $2. You can't build momentum that way. It creates a psychological trap where the effort feels totally pointless. I wanted to see if there was another way. I had to prove, mostly to myself, that with a different mindset focused on deep research and concentrated high-conviction bets, you could seriously grow a small account in a short time. This wasn't gambling. It was an experiment to see if a highly disciplined, research-heavy approach to high-risk assets could actually work. The $500 was small enough that losing it wouldn't be the end of the world, but it was real enough to make me take it very, very seriously. The goal was simple. Turn $500 into $5,000 in 6 months. A 10x return. And document every single step. The journey. Month by month. Months 1 an amp. 2. The grind and the first big win. The first month was a straight-up lesson in patience. It was brutal. I funded the account with $500, and for weeks, I did absolutely nothing but research. This is the part nobody ever wants to talk about. It's not sexy. It's just you, endless financial reports, and a mountain of coffee. I was hunting for a very specific kind of company, a small-cap stock that was deeply misunderstood or just completely overlooked by the market. These tiny companies often get zero analyst coverage, which creates pricing mistakes and huge opportunities for anyone willing to do the homework. My checklist was strict. Market cap under $500 million, a clear catalyst on the horizon, a sharp management team, and a story the market wasn't seeing. After weeks, I found a candidate. For this video, we'll call it Biogen Innovations. It was a small biotech firm working on a novel treatment for a rare disease. The stock had been hammered for months after a delay in their clinical trials. The market had given up. My theory was simple. The market was overreacting. My research suggested the science was solid, and the CEO had a track record of navigating regulatory headaches. The upcoming release of their rescheduled trial data was the catalyst. If the data was good, I figured the stock could double or triple. The downside was real. If the trial failed, it would hurt, but I felt the market had already priced in most of the bad news. So I made my move. I put $450 of my $500 into Biogen. A huge, concentrated bet. For the next 3 weeks, it was pure agony. The stock did nothing. It drifted sideways, then dipped 15%. I was down to under $400. The psychological pressure was insane. Every bone in my body screamed, "Sell!" This is where most people quit. Can you trust your research when the market is telling you you're an idiot? Then, at the end of week 5, the news hit. Phase 2 data was overwhelmingly positive. The market went nuts. In 2 days, the stock rocketed up 180%. My $450 turned into more than $1,260. I sold everything. I didn't get greedy. The thesis played out. Job done. Taking the profit was the only move. After 2 months of grinding and gut-wrenching stress, the account stood at $1,260. The challenge was on. Month 3. The humbling loss. With over $1,000 in the account, I felt like a genius. And that's when I made the classic mistake. I got cocky. I started believing my own hype, thinking I had the Midas touch. I ditched the painful research process that got me the first win. I found another company, a small tech firm in the renewable energy space. The sector was hot, and I got swept up in the narrative. I did some quick surface-level research, saw a few positive headlines, and told myself it was another hidden gem. I didn't do the deep dive. I didn't properly analyze their financials, or I would have seen the sky-high debt and shaky revenue. I ignored the red flags because I was infected with FOMO, the fear of missing out on the next big thing. I threw $1,000 into the stock, expecting another quick win. Instead, the company dropped a bombshell of an earnings report a week later. They missed revenue and lowered their guidance. The stock fell off a cliff, dropping 40% in one day. My $1,000 was suddenly worth $600. After selling and taking the hit, my account was down to $860. I was crushed. Not just because of the money, but because I had been an idiot. I broke my own rules. There's a well-known concept in behavioral finance called loss aversion, which proves the pain of losing is about twice as powerful as the pleasure of winning. I felt that acutely. This loss was the single most important moment of the whole challenge. It taught me a lesson no win ever could. Discipline is everything. Success doesn't give you a free pass to be lazy. It demands even more discipline. This loss humbled me and forced me back to square one. Without it, I'm sure I would have blown up the entire account. Months 4 and AMP. 5. The asymmetric bet and a wild ride. Humbled and refocused, I went back to the drawing board. With the account at $860, I needed another win, and it had to be a big one. I spent the next month buried in research, this time with a healthy dose of fear and respect for the market. I started hunting for what's called an asymmetric bet, a trade where the potential upside is many times bigger than the potential downside. I found it in a totally different sector, a small resources company specializing in a critical mineral for next-gen batteries. Again, totally overlooked. They were a tiny fish in a pond of giants. But they had secured exploration rights in a stable region with geological surveys hinting at massive, high-grade deposits. My thesis had a few layers. First, the macro story. Demand for this mineral was set to explode thanks to EVs and energy storage. Second, the company story. They were about to release their first official drilling results. The stock was trading for pennies on the dollar compared to its potential value if the results were good. The risk? The drills could come up empty, and the stock would be nearly worthless. A classic, high-risk, high-reward play. This time, my research was obsessive. I read geological reports. I looked at satellite imagery of their site. Everything. I felt confident this was a calculated risk, not a blind gamble. I took a deep breath and put $800 of my $860 into this one stock. This was it. Make or break. The weeks that followed were pure tension. Nothing happened. The stock barely moved. It was the quiet before the storm. I just held on, trusting the work I'd put in. Then the news dropped. The drilling results weren't just good, they were world-class. They confirmed one of the largest, highest-grade deposits discovered in a decade. The stock didn't just move, it exploded. It gapped up 100% at the opening bell and just kept running. Over the next few weeks, media coverage and institutional interest created a massive wave of momentum. I didn't sell all at once. I scaled out. I sold a third after it tripled, locking in my initial capital plus a nice profit. I sold another third when it was up 500%. I let the last piece run for another week before cashing out. By the end of month 5, my $800 investment had morphed into nearly $4,800. The total account was now sitting just over $4,860. The 10x goal was right there. Month 6, crossing the finish line. The last month was all about protecting that capital. The gambler in me wanted to take that $4,860 and let it ride on another moonshot. But the scar from my loss in month 3 was still fresh. The goal wasn't just to make money, it was to hit the target and prove the strategy. I took most of the money off the table. I found one last, smaller play. A classic value stock, a small, profitable company trading below its book value because of some temporary pessimism. It wasn't a 10x stock, but I figured it had a solid chance of a 20–30% pop after its next earnings call. I put $1,000 on it. 2 weeks later, they beat expectations. The stock jumped 25%, and I sold immediately for a quick $250 profit. And that was it. Challenge complete. The final balance, after accounting for fees and setting aside money for taxes, was $5,110. It was a wild ride of intense research, extreme patience, gut-wrenching volatility, one humbling failure, and 2 absolute game-changing wins. The core strategy and AMP. Lessons learned. So, what's the playbook here? What are the actual principles? It really boils down to 4 things. Pillar 1. Hunt for asymmetry. The whole strategy is about finding spots where the potential reward is ridiculously bigger than the risk. I wasn't looking for stocks that could go up 20%. I was looking for stocks that could go up 200% or more, where the downside, while painful, wouldn't wipe me out. This means you have to wander away from the big famous stocks and into the weird world of small caps where things get mispriced. Pillar 2. Become an expert on what you own. You don't find these asymmetric bets by skimming headlines. You have to do the work. For each stock I bought, I probably spent 40+ hours researching. That means reading every SEC filing, listening to every investor call, and building a case for why you're right and the market is wrong. You need to know that company so well that if the stock drops 20%, you have the guts to hold on, or even buy more, because you trust your work more than the market's panic. Pillar 3. Master your psychology. This is the hardest part, period. High-risk trading is an emotional nightmare. You have to build a system to keep your own brain from sabotaging you. For me, it was writing down my thesis for every trade. When fear or greed kicked in, I'd read it. Did the facts change, or am I just freaking out? You also have to have the discipline to actually sell and take profits. Hope is not a strategy. Pillar 4. Position sizing is everything. With a small account, you have to be willing to make concentrated bets to get that exponential growth. But this isn't just going all in on a whim. It's a calculated strike. My rule was to bet a big chunk of my capital, between 50% and 90%, but only on the absolute A+ setups. The 1 in 100 opportunities where my research gave me unshakable conviction. Everything else is a pass. This aggressive approach is what creates the big wins, but it's also what makes it so dangerous. You have to be right. This process of deep dive research is something I'm still doing every single week. If you want to see how I break down companies and get my thoughts on the sectors on my watch list, I put it all in my free weekly newsletter. There's a link in the description. It's the best way to get a deeper look at my methods without any of the hype. So, can you turn $500 into $5,000 in 6 months? Yes, it's possible. But it's not easy, and it is definitely not guaranteed. It takes an obsessive amount of research, an iron stomach for volatility, and the discipline to follow your plan when it feels like the world is ending. It's a path paved with high risks and high rewards. This whole journey taught me that explosive growth isn't about a magic formula. It's about building discipline, developing real expertise in a niche, and understanding that failure isn't just a risk. It's a tuition payment for an expensive education. The biggest win wasn't the cash. It was proving that a disciplined, research-first approach can work, even when the odds feel stacked against you. Now I want to hear from you. What's the single biggest challenge you're facing with your own account? Is it finding good stocks, managing the risk, or just the psychological battle? Drop a comment below. I read every single one. And if you got any value out of this story, do me a favor and hit the like button and subscribe for more transparent, no-fluff content. Thanks for watching.